Good evening, everybody. Welcome to the post-budget presentation by the Nirmal Group. I'm Girish Pai. I'm head of research of the institutional equities team. Our presentation today will have elements from the institutional research desk, insights from the institutional research desk. We will have the retail research team presenting after us, followed by presentation by the commodities research desk and then by the mutual funds research desk. So let me just give you a few guidelines here. Those who are presenting, you switch on your video and your audio only when you are speaking. Otherwise, keep your video and audio mute so that we have a good experience, so to speak, for everybody. So let me just start off with the presentation from the research team. Let me just share the screen for the research presentation. So to start off, I would say that budget as a market moving event has probably become less critical as time has gone by, because a lot more elements, a lot more decisions are being taken outside of the budget, and with indirect taxation, completely out of the picture because of GST. A lot of the unknowns or imponderables have gone out of the budget. It's become a much more predictable event, so to speak, and that has led to lower amount of volatility in the last many years now compared to, say, 10 years back. So I would say this budget, I would characterize as there's not much of bad news, so that is a good thing in my opinion. Just a couple of backdrop points. So the economic backdrop has been a situation where we've seen very strong economic growth in FY22, or we will end in FY22 with about 9.2% real GDP growth. After a very disastrous FY21, which is probably down about, I think the revised number is 6.6, so thereabouts is what I understand. The other thing that from an economic perspective one needs to be cognizant of is the uncertain global outlook. While there's been a very strong revival in all developed markets, they've all been plagued by inflation, and there is a element of risk around growth connected with the central bank tightening of liquidity and interest rates. The third element is, there are still parts of the Indian economy which require some bit of support because of the fact that they have not reached pre-pandemic level performance. From a stock market perspective, last year we did very well. Indian stock market, Nifty was up about 27 or 28%, and we're talking calendar year here. 2021 we were up about 27 or 28%. This is significantly better than the MSCI emerging market performance, which was down about 2.5% or 3% or thereabouts. In 2020, we were at par with MSCI emerging market performance, which was in the 15-16% up region. So we were at par with MSCI emerging markets. Last year was a standout performance. The second is that we had very strong index level earnings growth last year, and this is probably the first time we've seen that kind of situation arise. Pre-pandemic, we were clocking mid-single-digit index earnings growth. The other thing which has probably been a bit surprising has been the resilience of the market despite very strong FII outflows. At least we've seen episodes of fairly strong selling by foreign portfolio investors, and the index hasn't really fallen that much. That's been largely driven by fairly strong domestic flow. So incremental household savings, a larger part of it is actually going to equity. So that's resulting in, I would say, a more resilient market performance. And both domestic institutional investors, that is money that is flown, household money that's flown in through the mutual fund route, and also direct route. I think both are kind of helping the market stay up despite very strong selling from the FPIs. So, of course, Going back to the budget, what was good and what is what is not so good. So the good part is that spending has been in a particular direction, in the sense that it's been more capex oriented, which is what the market had aspired that budget to be. So that is what we've seen. In revenue expenditure has been, I think, 1% up, so it's been broadly flat. There were also some concerns whether there'll be some SOPs given out because of elections in UP and other places, Punjab and all that. None of that kind of featured in the budget, so that was the positive aspect. There were no populist political SOPs or anything of that sort. It was largely the spending, and all the budget related items were largely medium to longer term oriented. There were some job creation aspects connected with the PLI schemes. The math seems fairly credible, and I think this is something that Teresa will get into, our economist, who's going to get into a little bit more detail. And probably, while I don't think there'll be a positive surprise in the revenue front, or as big a positive surprise in the revenue front as one has seen in FY22. Maybe there's a little bit of room there, but not as much as what one has seen in FY22. Earnings growth expectations have moderated a bit into 23 and 24. We are expecting about anywhere between 15 and 20% index level earnings growth. I think this budget is kind of going to be supporting that to some extent. I would say the 65,000 crore divestment target is probably a bit conservative. There's been no, I think one of the good aspects in the last couple of, I think at least this budget has been, there's been no tinkering with taxation. Maybe to the disappointment of some parts of the population, but I think stable taxation is good. And there were no nasty capital market taxation related surprises, in the sense that no changes in STT, short-term or long-term capital gains and stuff like that in the fine print, which is again a positive aspect. I think probably one of the big takeaways has been this thing on crypto, that there's going to be taxation on income capital gains from crypto to the tune of as much as 30%. And it's going to be brought under the TDS regime, which means that there's going to be a tracking, a digital trail of the players, which could mean that there is going to be some bit extra capital that's going to flow into the equity markets, is the way I would look at it. So what I did not like was there was a lot of talk around rural demand being very weak by various companies in the 3Q results and even the 2Q results. And there was some hope in the market that the government would do something direct, in the sense that improve the purchasing power of the rural folks. And there was also some talk about urban bottom of the pyramid also getting impacted by what's happened in wave 2 and wave 3. That has not been addressed in the budget in one sense. So the K-shaped recovery that people keep talking about, I think that has not been addressed. The other thing is the net borrowing number optically looks a little challenging, which has probably led to the very significant hike in increase in the 10-year yields by almost like 17 basis points in one day. That's a very, very big number, very high number. Probably during the course of the next few days, my sense is that the bond market people are going to probably read the fine print and probably come to the conclusion that some of the estimates, revenue estimates, are probably conservative, and there is probably more money to come in through divestment, maybe revenue outperformance and stuff like that, which could mean that the net borrowing could potentially be lower. The other has been about no taxation, capital gains taxation for foreign investors, which was broadly expected, because that was supposed to lead to India joining the global bond indices, or at least being in a position to join them, and that would have meant somewhere between $20 to $40 billion of flows into the Indian market, is what I understand. Maybe this is going to happen outside the budget, so we'll have to probably wait and see. So I'm going to keep my presentation fairly short. So what we like, these are the stocks that we like. I don't want to get into Nifty price target and stuff like that. We, as a house, we don't do that. We are more into stock picking, and these are the stocks our team is going to discuss in the next many minutes. Each individual analyst is going to come and discuss this. So I would kind of pick out a few names here. I think in the financials, I would kind of pick out in large caps, ICICI Bank, HDFC, SBI Life. In IT services, we like HCL Tech and Tech Mahindra. In energy, we like, in the large cap, we like GAIL and some of the OMCs. In consumer companies, we like HUL and Britannia. In auto, our key picks would be Ashok Leyland, Bajaj Auto, Mahindra and Mahindra. In consumer durables, electricals, those would be consumer, Crompton Consumer, Whirlpool. Infrastructure and cement, I would probably think Ultratech, Ramco, PNC Infra, KNR. Pharma, the key stocks would be Dr. Reddy's, Sun Pharma and Cipla. Chemicals, UPL, Sumitomo. In specialty chemicals, Naveen Fluorine, and in some of the mid caps, I would say CCL. Real estate, we like the South-based players, Brigade and Prestige. And in logistics, we like Concor and Blue Dart. Just a few points on risks. Obviously, we didn't expect wave 3. Honestly speaking, we thought by with wave 2 we were broadly done. So I'm not very sure whether they're going to have a wave 4 or even anything beyond that. So that is a risk that we kind of carry going into FY23. The other risk is whether central banks are going to react very aggressively to the inflation that's running very high, much higher than what they're comfortable with. And would that involve significant actions on the interest rate side, which could push economies into recession? So that is a risk that exists because some of the economists are of the view that central banks are probably behind the curve. So that there could be a situation where there could be very significant interest rate increases that could lead to a very big compression in economic growth towards the second half of 2022, and can we talk calendar year 2022 and early part of 2023. So hope that doesn't happen, that central banks and I hope inflation behaves for that to happen. So I hope that we don't have a situation where from a red hot market from an economic perspective go to a recessionary situation all within say 4 to 6 quarters. So broadly, that's what I have right now. And now I will ask Teresa, who's our economist, to give her take on the budget. And I'll come back and speak on the IT services sector at a later point in time. So over to you, Teresa.
Thanks, Girish. So I'll just take to the quickly go to the from an economist perspective, the key takeaways from the budget. And
Teresa, I'm going to be using. I'll be the one who will be running the PPT.
Yeah, sure, no problem. Yeah, so from an economist perspective,
we can't hear you.
Can you hear me now?
Yes, we can hear you. Please go ahead.
Okay.
Teresa, you're audible.
I can't hear you.
Oh, okay. Yeah. Can you hear me now?
Yes, you're audible. Please go ahead.
Sure. So I'll just share some of the key takeaways from an economist's perspective. So overall, the orientation of the budget was largely in line with what we were expecting and what the market was expecting. So there was a huge focus on capex, which is very good from a growth perspective. So in FY22 itself, the capex is up by around 41% on based on the revised estimates. I wouldn't read too much into that because part of the increase in expenditure is coming from the government actually clearing some of Air India's previous liabilities. But even on that, we are looking at a 25% growth on capex in going into FY.
Abhishek,
Sir, she is audible, sir. Teresa, please go ahead.
Yeah. Girish, can we go to the next slide? Or yeah, so and on that we are looking at like a 25% growth in capex in FY23 on FY22 levels. And what the other positive coming off from the budget is that a lot of the assumptions look very reasonable. So if you're looking at your nominal GDP growth, you're working with 11% nominal GDP growth, and even the tax assumptions. So Girish can't hear me, so yeah, okay.
Yeah, I can hear you now. Sorry,
Okay.
there's a problem at my end.
Okay. So the key focus in the budget, Girish, can we just go to the next slide? Sorry. Yeah. It's been capex all the way. So if I look at some of the key expenditure heads, there's been like the key. So your PM Gram Sadak Yojana is seeing like a 36% growth in FY23 over FY22 levels. Similarly, even your budgetary allocation to railways is seeing like a 17% growth. So it's but if you look at it, something like a Narega, which has been a key support for the economy during the pandemic, we are actually looking at a 25% decline over the FY22 revised numbers. But it's broadly, if you look at it compared to the FY22 budget levels, it's actually a 0% growth. So clearly, the government's focus is shifting very significantly to capex. So roads, railways, those are the sectors which are seeing significant expansion. NHAI is not seeing a very big expansion this year, largely because in FY22 there has been like a 41% increase, and on that it's broadly flat. But overall, the highest allocations are going into roads, railways, and maybe some of the softer areas like education. So can we go to the next slide? Yeah, but so education is also seeing like a 18.5% year-on-year increase over last year's levels. But if we look at rural development, the expenditure is broadly flat. Agriculture also, the growth is slowing from around 10% in FY22 to just around 2%. So it's largely a shift towards capex all the way. So apart from education, again here, the sector that you are seeing like close to 10% growth is in transport. But even interest payments are obviously rising because of higher debt. But even sectors like defense, there is only like a 5% growth over last year's level. So this clearly hard infrastructure and soft and some soft skills like education, which are receiving a large portion of the government's budgetary allocations this year. So this is in line with expectations. So I wouldn't be too worried. But the concern is that can we go to the next slide? The concern is that I mean, if there is a large compression on rural agriculture spending and to overall revenue expenditure, then and your capex doesn't actually pick up as anticipated in the budget, then there could be pressure on growth. But overall, I think we would be happy with the direction that the budget has taken. And even on the tax revenue front, at least for the last 2 years, we've seen very reasonable tax assumptions compared to what it was previously. So we are working with a total tax revenue increase of around 10%, 9.6% to be precise. And this is on the nominal GDP assumption of around 11.1%. So this is a very reasonable assumption. The highest increase that they are anticipating is on GST, but we are actually seeing increased compliance over the last a few months, and GST collections actually be robust. So even there, I wouldn't be too concerned whether targets will be met. If at all, there is, I think there could be some room for a positive surprise, even if it is maybe a marginal positive surprise, not like we've seen in FY22, but there is still some room for positive surprise because of the lower nominal GDP growth that has been assumed. Can we go to the next slide? Yeah, so the few things that have worked, first is the focus on capex overall, and apart from the on balance sheet spending by the government of India, the government of India is actually giving another 1 lakh crore as loan to states. That's an interest-free loan to states to spend on capex. In addition to that, they're making around maybe roughly around 3 lakh crore as grants in aid to the states for capex. So it's like the center and the states are coming together to spend on capex. So the multiplier effect of this can be quite huge. Secondly, the fiscal deficit per se in FY22 is at 6.9%, and that is coming down only gradually to 6.4%. So our own estimate for FY23 fiscal deficit was 5.8%. So it is quite significantly higher even compared to what we were anticipating. So, but from a spending perspective, this is positive because the budget continues to remain growth supportive. And lastly, as I mentioned, so all the assumptions on the tax front, even on the divestment front, the divestment target is around 78,000 crore for FY22, which has been revised down by nearly 1 lakh crore. But for FY23, the assumption is only 65,000 crore, which is again a very reasonable assumption. So these reasonable assumptions plus the capex push and gradual fiscal consolidation have all worked well for the market. So I think that's why you saw the equity market rally. Can we go to the next slide? But the main concern from our side is that the gross borrowing number, has actually come in, completely above all estimates. So the gross borrowing number is close to 15 lakh crore, whereas the expectation was that it would be close to maybe 13 lakh crore, it not more than that. So it's 2 lakh crore higher borrowing, and at a time when the RBI is also tightening liquidity and it may start hiking rates also in the not so distant future. And the net borrowing number also has been consequently higher. So the number was, our expectation was that it would be close to somewhere 9.2 trillion. So the actual number is about 2 trillion higher again on the net borrowing side. So the key concern is that as Girish mentioned, the yields have already moved up by around 15 to 17 basis points today. So if interest rates rise, some of the capex push could be detrimental, because the idea behind the government's capex push is that private capex will pick up, after the government leads the way. But if the interest rates rise, then the private capex recovery that the government is anticipating, that we are also expecting, may not play out as expected. Secondly, if the yields rise, the other income for most of the banks could get affected because of the mark-to-market losses that they will have to take because of the rise in yields. So that is also a cause of concern. So overall, if the yields rise very sharply, then the equity market rally that you have seen today could actually fizzle out. So that is a key point of concern. Delay and shortfall in implementation of capex, that is a concern. But if I look at the track record of this government, I would say with 90% probability, they actually fulfill most of their capex intention if you look at the track record of the last 5 years. So there has not been major slippage compared to what has been budgeted. The final concern is that the revenue expenditure growth is very muted. If capex is delayed for some reason and the revenue expenditure is flat, then your support from government spending towards the overall growth in the economy would be very slow. So that can actually act as a drag because private consumption as a whole is yet to pick up because of the K-shaped recovery that we've seen in the economy. So the informal sector is still affected, because of the lingering impact of the pandemic. Can we go to the next slide? So those are our concerns, but I think there is some room for positive surprise, particularly on the revenue front. There could be not a very big beat on the expectation. There could be at least a marginal beat on the expectation. Then small savings inflows have been quite robust over the last couple of years, and even in it's close to 6 lakh crore in FY22, which could come down. Which is budgeted in the numbers. It's budgeted, it'll come down to 4.2 lakh crore. So that's nearly a 1.8 lakh crore decline in the small savings in FY23. But this could actually surprise on the upside, particularly if the the low interest rate environment continues, because the small savings offer a better interest rate. Third, again, the divestment flows have been very conservative estimates, 65,000 crore, that there could be a beat on that as well. Particularly if you see some of the big ticket IPOs going through this year or early next year. So there could be a beat on that. The RBI dividend also, there could be a surprise, because the again, similar to last year, there has been the balance sheet expansion has been quite muted, and we've also seen a depreciation in the rupee. I mean, from RBI balance sheet perspective, that actually works well. So they could pay out a higher RBI dividend, which is not really factored in the budgeted numbers. And also one of the key themes in the budget today was on the launch of the 5G spectrum. So if that spectrum auction goes through, there could be some positive surprise, which again, I don't think is really factored into the number. So these are the few elements where you could actually see a positive surprise on the revenue front, and that could actually provide a cushion against the high borrowing number that you have, that the government has announced. So maybe the yields could fall, because in the coming days, once the market anticipates that there could be some positive surprises as we move along in the year. Yeah, so that's it from my side. And I think now our auto sector, Ronak and Mohit will take over.
Hello.
Yeah, Ronak.
Yeah. Good evening, everyone. For the auto sector specifically, this time, not much was expected, mainly because government had already announced many policies related to autos in last 1 year, which includes FAME2 policy, advanced chemistry cell for batteries, auto PLI schemes, and many more. So this time it was kind of a non-event for auto sector. But specifically, some of the points. So I'll cover it. I'll cover auto ancillary part of it, and Mohit will look after auto OEMs. So specific announcements for auto ancillaries were so firstly on the defense side. So with the aim to reduce the import and promote Atmanirbhar Bharat, so government has increased the defense budget by about 10% to 1.5 trillion rupees. And now 68% of this budget will be earmarked for the domestic industry as against 58%. So this will be beneficial for some of the forging companies like Bharat Forge, which intends to be one of the major defense player. Apart from this, there were some announcements in relation to the reduction of custom duties or revocation of additional dumping duty on the commodities. This was mainly to reduce to ease the supply constraint and inflationary pressure, which is being faced by auto industry since last 6 months. Just to name a few, so the government has reduced additional dumping duty on steel imports, and they have also reduced custom duties on tire cord fabric, rhodium, and pig iron. So these are some of the key metals which are used by the auto companies, and going forward, this will reduce some inflationary pressure for the industry. Apart from that, just one more announcement. So on the CNG side, so government has reduced the custom duty on the CNG kits from 5% to 0% now. So this is largely to boost the adoption of CNG. The government has been promoting adoption of use of alternative fuel for the automotive sector, and in line with that, they have reduced the custom duty on the CNG kits. So I'll now hand over to Mohit, who will look after OEM.
Good evening, everyone, and thank you, Ronak. So overall, as Ronak pointed out, there was not much for the auto sector, particularly considering we had a round of policies over the last 18 months. Specifically on OEMs, the government indicated further support for EV transition through its battery swapping policy, No further details were provided, but this clearly indicates that the government has a clear roadmap on how they would want to support the EV transition. So overall, they mentioned that in the urban areas, there are some space constraints for setting up charging facilities. So overall, we view this as positive, but setting up extensive battery swapping network would entail additional capex by incumbents, and we believe that the upfront cost differential could significantly get reduced when the mechanism is established. So overall, a battery constitutes 45 to 55% of a total cost of an electric vehicle. And if a battery swapping model is generally supported and evolved, this could bring down the cost materially and could lead to an accelerated transition to EVs as compared to broader expectations. However, we note that there are certain execution risks because different incumbents have different views on how the charging infrastructure is going to evolve in the near to medium term, but a specific government policy on battery swapping paves the way for standardization in the charging infrastructure, which would also lead to a better sense on how things would move. Specifically on the battery swapping policy, we think that Hero MotoCorp is a company that would be the most beneficial of this because it has a partnership with Gogoro, which is the world's largest battery swapping operator, and they are going to launch a vehicle that is based on battery swapping policy on later half of this year. So overall, I think this policy could significantly lead to a positive momentum for Hero. Apart from that, in autos specifically, we like Ashok Leyland as a play on the impending CV cycle, and on the other picks, we like Bajaj Auto, TVS, and Mahindra. One of the negatives in the budget was there was no increase in the road debt rates to make exports more competitive, and GST rates would also not reduced, which is a long-standing request from the industry. So overall, net, the budget did not have much for the auto sector, but a clear indication on a battery swapping policy would provide some more clarity and standardization in this process, which could accelerate EV adoption. So that would be it from the autos team. I would now like to hand over to Raghav.
Hi, good evening. So I think in terms of the budget announcements with respect to the BFSI sector, there weren't as many announcements as we had heard last time, but still I think there are two key positives coming out of this budget. So one is, of course, the thrust that the government continues to lay on the development of the infrastructure in the country. They have increased the capex outlay by about 35%, which only reinforces their stance towards this sector. Now, the banking sector may not be a direct beneficiary of this as in a direct proxy play, but I think in terms of the lending that we could expect, the pickup in corporate lending that we could expect should stand to benefit the large banks that are there, which have a established corporate lending track record. As far as the non-banking sector is concerned, so in the NBFC sector, the auto finance NBFCs would stand to benefit the most, which primarily cater to CV financing. So these would be Shriram Transport and Sundaram Finance, as plays in the non-banking space. The other key positive that came out is that the government continues, to contribute towards development of the affordable housing sector in this country. So they have allocated another about 480 billion towards completion of 8 million houses under the PM Awas Yojana. And they would continue to work on other measures also for promoting affordable housing for the middle and the economically weaker section. So I think the overall thrust on affordable housing is a positive for the housing finance companies, especially the ones that are focusing on affordable housing. So our play in the listed affordable housing finance sector would be Awas Financiers, which based on company fundamentals and specifics seems to be the biggest beneficiary of this. Then other than that, the third announcement, important announcement, is the announcement of extension of ECLGS. And they have expanded the scheme to 5 lakh crores. They have expanded it by 50,000, and this is exclusively earmarked for the hospitality and related sectors, because that has been one of the sectors which has been impacted the most because of the COVID. And they have also extended the last date to end of March 2023. Besides these three, there are two other announcements which are mostly related to the government, taking measures to develop digital banking. So they will be establishing 75 digital banking units in collaboration with the scheduled commercial banks. And then the last one is the introduction of the central bank digital currency, which is expected to lead to a more efficient and cheaper currency management system in the country. So overall, in terms of stock picks, we like ICICI Bank, and we also like SBI Bank. In the housing finance space, we like Awas, and we like HDFC Limited. And we were expecting some measures in the life insurance sector also, especially on the GST rate that's currently there for the term plans, because if that's reduced, then that would really push the growth, the protection segment growth for the life insurance companies. But it did not materialize this time. So despite that, we still like SBI Life, which is our top pick in the life insurance space. So that will be it from my side. And I guess the chemical sector is next. Thank you.
Yeah, hi. Good evening, everyone. If the budget was positive for any sector, I think cement and infra would qualify as the two wherein the overall most of the announcement were directed towards these. So for cement sector, the key problem recently has been lack of demand, and because of that, they were not able to push the pricing up and pass on the increased cost to the consumers. So what does this budget do is basically, at least in terms of demand, the demand which comes from the infrastructure sector, that probably should continue for the next 2 to 3 years based on this, because this is the third year in succession wherein the capital expenditure from the government side has been increased substantially. So we expect that the trickle down effect of that is going to be much higher, and that's going to lead to higher cement consumption through higher infrastructure, as well as through certain part in various other housing related initiatives that have been taken by the government as well. So if you notice the budget speech of the finance minister, it started from PM Gati Shakti, which is basically a master plan, wherein the idea is to coordinate well within the various ministries as well as within various central and state government ministries, and make sure that the effective implementation of infrastructure has taken place. So even though the announcement is on the higher side for either central as well as the state government expenditure, we believe that the strength lies in the way these guys are going to implement it, which is through the PM Gati Shakti master plan, and that's going to lead to faster implementation than what we have seen in the past. But as it goes with most of the announcements from the budget, even this is not something that's going to kickstart the demand for cement, say, very soon. But as I mentioned, that over a longer term, the demand momentum looks very strong, and we expect that higher than GDP growth demand for cement will sustain in foreseeable future. On housing for all, allocation has been increased, so affordable housing demand should pick up. On the negative side, I think Manrega, the overall allocation is on the lower side, so that could possibly have some impact on rural demand for housing. And on cost front, there have been a couple of moves from the government, that they have reduced duties on imported coal from 10% to 5% and gypsum from 10% to 2.5%. Now, given the way imported coal costs are, this is going to provide a marginal relief to cement. It's not going to provide a very large relief because anyway, these costs, the imported coal and other costs have actually gone up more than 100%. So that 100 coming down to by 5% is not going to make a huge difference. But effectively, it's just going to offer some respite. And if the commodity prices are to go down from here, then obviously along with this measure, it will help a lot. There has also been one more announcement that Portland, they have reduced import duty on Portland cement to nil. So that means the imported cement would actually have lower tax incidence than what the India manufactured cement will be. So this is an inverted tax structure in my opinion. But I don't know the reason behind introducing this. Anyways, the imports, cement imports into the country are not very high. So barring few regions, it is not going to impact substantially for the sector. So if you look at next slide, please. So if you look at the allocation that has been done to the various ministries, we have seen decent allocation, and we have only looked at the schemes or the schemes or the ministries or departments that are there, which are basically more cement incentives. So Manrega, Jal Jeevan Mission, Pradhan Mantri Awas Yojana, metro project, NHAI and road works. So NHAI, what government has done is, so NHAI receives money through two parts. One is through the budgetary allocation, and second is through IEBR. Now, what the government has done, IEBR is basically extra budgetary resources. What government has done in this time around is that they have increased the budgetary allocation to the authority, but they have reduced the IEBR to zero. So net increase in overall allocation to NHAI has not been very high. And that probably is because of the bad balance sheet of NHAI. So they have been asked not to raise money on their own, but they have been helped through the budgetary allocation. But overall, even if they maintain the current run rate, I think that's going to be positive for the sector. So overall, if you include road works or other metro projects and others, I think there has been a decent increase. So compared to the revised estimate of FY22, we are looking at almost 17% increase in overall outlay on these major schemes. So it's a positive impact on the sector. And the stocks that I would select would be Ultratech, Ramco, Birla Corp, and Sagar Cement. So these are stocks available within various market cap levels, but those are the ones I think should do well in cement space. Shall I take up infra also, or? Yeah. So same is for the infrastructure sector as well. So if you look at the capital expenditure from the government, this has seen almost 24% increase from the RE revised estimates and 35% from the budgeted estimates for last year. That's going to continue the overall, and even on the opening remarks, the FM did mention that under PM Gati Shakti, they have finalized 7 pillars wherein the investment will go in. So those are like roads, railways, airports, metros, logistics, infrastructure, etc. And therein, most of the investment will be in these sectors, which would actually have a very large trickle down effect on the economy. So we expect that the awarding activity because of this is going to be robust. What we do want to know is whether there is going to be competition in that awarding activity, which has an impact on margins. That's going to take some time to find out. But overall, if you look at most of the announcement from the government side, it actually had a it was tilting towards high capital expenditure. And there was an interesting line that was mentioned earlier also within the report, that they basically want to revive the private capex, and the impetus for that should be given by the higher public expenditure. So they will increase the public expenditure and make sure that the private sector is strong enough to do the capex on their own. And that's the virtuous cycle of investment that they have talked about. So idea is to keep investing in the economy, which helps the private sector. And when it helps the private sector, it's going to help increase the overall investment in the economy. Then there are list of projects that they have mentioned. There are projects for river linking. They have also talked about almost 25,000 kilometers of new national highway network expansion. Very large expressway, a plan for expressway to facilitate faster movement of people and goods. And then also on Jal Jeevan as well as PM Awas Yojana, they have mentioned that they have increasing their allocation. So overall, most of the announcements were good. On the next slide, I have given the breakup for the road ministry in terms of how the actual increase has been there. So if you look at the overall expenditure heads of the Ministry of Road Transport, they are spending say 646 billion on road works, and for NHAI they have allocated 1340. So there has been a large growth in the expenditure, but as I said, NHAI generally used to raise money on their own, which was part of IEBR. So overall investment, even though it looks higher here, it may not be as high compared to what we have seen in the past year. Even if they maintain that momentum, we expect that it is going to be positive. Within this space, what we generally look at is the companies with clean balance sheets and very low working capital. Those are very so clean in the sense very low debt on the books as well as very low on the working capital. So KNR and PNC continue to qualify under that criteria, and we believe they could be a good beneficiaries of the same. So those are our top picks from the infra space. I think next is on the chemicals. I'll hand it over to.
Hello. Hello, can you hear me?
Yeah, go ahead.
Yeah. Good evening and thank you very much. Trust all of you well. So if you look at the budget, I'll be handling both chemicals and oil and gas. And I think the more actionable announcements were in chemicals. My colleague Abhishek will talk a little bit more on the methanol and acetic acid import duty reduction. So overall, it's positive for the entire chemical chain. The duty has been reduced by 2.5%, and it will improve the cost competitiveness for companies making chemical intermediates for and active ingredients for the crop protection chemicals, as well as the custom synthesis and manufacturing companies in the chemical sector. And this is in line with the government's plan to build globally competitive capacities in the entire chemical chain, particularly for making inputs for the agrochemicals and pharma sector, where there's a certain amount of concern about the excessive dependence on China. So both to diversify the supply chain risk as well as to take advantage of the opportunities based on the China Plus strategy of the global companies also looking to source chemicals from other vendors, including from Indian vendors. Now, if you look at the fertilizer sector, the government has cut the subsidy allocation by 24.9% compared to the revised estimate. And this is a decline on a base in FY22, which rose substantially by 76% because of the steep increase in the price of inputs like ammonia and phosphoric acid. So that led to the increase in the subsidies for both urea and the phosphoric fertilizers. So we note the NBS subsidy has been cut 34% for the coming financial year, and that could be a little bit of a concern for the phosphoric fertilizer companies. Although what we understand is the government usually, does ad hoc increases to ensure that the farmer gets the fertilizer at competitive prices. But we need to keep an eye on the inflation in the global chemical prices and freight rates. And there could be some need for increasing the subsidy allocation later on. And if you look at the overall allocation for the agricultural and allied sector, there's a marginal increase of 2.5% to close to 1.5 trillion rupees. So that's heartening. Although there's a marginal decline in the crop insurance by 3%, but still a reasonable amount. So if you look at the overall policy thrust, apart from the government's endeavor to go for what they call soil mapping and the soil health based application of nutrients, they're also looking to encourage the production and use of non-chemical sustainable organic chemicals for both agrochemicals in the crop protection chemical sector as well as for fertilizers. under the philosophy of zero budget organic natural farming. There's been some discussion on this over the last couple of years, and they have made a mention that they would like to give it further impetus. So we need to still wait for how they are going to do that. What we understand from the earlier discussions is that they would like to direct the subsidies based on the increasing share of use of organic material by the farmers. So that will be interesting to see how it evolves. And it will also encourage the development of safer and newer crop protection chemicals. So there could be both opportunities as well as some amount of interim risk for the companies. So the companies who are able to focus and increase the share of bio solutions in both crop protection chemicals and biofertilizers and sustainable products will benefit. And we already seen that UPL has made a strategic statement of intent to focus on sustainable products and biosolutions, and they are among the world leaders in biosolutions. And we know that Coromandel in the fertilizer segment has a crop protection chemical business, and they are also looking to develop their portfolio of biosolutions in both biofertilizers as well as biopesticides. In fact, they have launched a biopesticide in the current financial year. And if you look at the custom synthesis major PI industries, they are looking to develop green chemistry to offer sustainable solutions in the chemicals outsourcing space, so that they're able to meet the net zero emissions and the global sustainable goals. So these are the kind of companies which could in the longer term be able to manage the transition as we move along the development of the industry towards sustainable development, green solutions, as well as the zero budget and organic chemicals for the agrochemicals and crop protection chemicals. Finally, in terms of the soda ash business, we have seen and heard a lot about the potential for the growth in glass, container glass, and the hospitality sector, replacement of plastics, and the impact of the increase in the investments in renewable energy, particularly for solar panels, which will create additional demand for glass. And if you look at the kind of impetus government is giving for the metro and smart cities, construction and business parks, this could create demand for glass structures in terms of buildings and public facility stations and the metro cars, the rail cars, as well as the increase in demand for mobility will increase the demand for automobiles. So I think there's a potential for longer term structural thematic upside in terms of the domestic demand for soda ash. And that could be positive for companies in the soda ash business, including Tata Chemicals, although it could be a slightly longer term 5 to 10 year kind of structural story. So in terms of our key picks in the chemical sector, we are positive on UPL, Sumitomo Chemicals, and Coromandel International. So that's it on the chemical sector. So if you can move to the oil and gas sector, I'll be glad to take that. Yeah, in the oil and gas sector, there was no major direct budget inference, which is positive or negative. One may say that in the push for blended auto fuels, where they have said non-blended fuels will attract a higher excise duty, could cause some concerns in terms of the differential pricing. But the government's intent is to encourage ethanol blending and blending with other fuels to reduce the fuel import bill and also to reduce the pollution and reduce the carbon footprint. And to that extent, they're encouraging the blending of alcohol, ethanol. And so that means your non-blended petrol and diesel will be more expensive by 2 rupees per litre based on the higher excise duty. That's likely to be effective from October 1. So we'll have to see how it evolves in terms of the demand and supply and pricing, and how the public takes it, and how the industry is encouraged to increase the share of the blended blended fuel sold, as well as the proportion of blending, which the government wants to take to 20% of ethanol in petrol and diesel. What we understand from earlier discussions with technical experts is that there are some technical constraints in terms of compatibility of the current engines with the higher share of alcohol, ethanol in the petrol and diesel, particularly for diesel vehicles. So we need to see how the technical compatibility issues are sorted out. But otherwise, this is the long-term mission, and this has been done in other countries like Brazil, for example. So I think it's not something that's difficult, but it will possibly take some time. So the other more interesting development in the energy and oil and gas space was the government's overall thrust on green energy initiatives, which encompasses all sectors in the economy. But it's also of interest to the energy sector because they are in the forefront, both in terms of their need to reduce their carbon footprint as well as the opportunity to invest in green energy. And it could pretty much attract all the oil majors, the PSUs, the OMCs, BPCL, HPCL, IOC, gas major GAIL, and unrated companies like ONGC and Reliance. And the interim impact is going to be a bit difficult to predict because we are navigating through a transition which will, involve the conventional fossil fuel industry as well as the new industry which has to, be developed in terms of infrastructure. But the government's intent and the desire to give infrastructure status for battery charging, storage, grid scale battery and clean energy storage, and also the new financing mechanism through green bonds to raise money for the government to fund green projects are all positive in terms of the longer term, investment push that we can see, and the incentive for the private entrepreneurs to come into the sector, because the infrastructure status is something which a lot of industries have been clamoring for, and that will be positive in terms of raising money at a cheaper rate, and also getting international funds and international agencies to come in and invest. And if you look at the companies, if you notice, IOC has been taking the lead in terms of the alternative energy mobility markets, and they were the first to announce their intent to get into the battery swapping model. And they're also exploring both lithium batteries as well as alternative technologies, including lead acid battery and aluminum air batteries. And they are planning to add 10,000 EV charging stations and also ramp up the battery swapping infrastructure. And they'll be supported by BPCL and HPCL, who have similar plans in battery charging and battery swapping. And if you know, the earlier speaker had mentioned in the auto sector, they had mentioned about government's plan to develop the electric vehicle ecosystem, the fame to encouraging more and more conversions, as well as develop the national infrastructure for battery swapping and taking care of the interoperability standards to ensure that, the charging stations and the specifications of the batteries in the charging infrastructure is, able to mesh with each other, and you are able to have electric vehicles driving long distances without being worried about the compatibility of the charging infrastructure. Because in the US, for example, I believe it's a big challenge now, because they are having challenges in terms of the range which each vehicle can apply with a particular type of battery. So this is something which is very important. It's good that the government is addressing that and trying to bring together some kind of harmonization of the standards, which will go towards developing a national ecosystem for electric vehicles as well as electric batteries. So they're also talking about electric vehicle mobility zones like the green corridors they're talking about. And this will, be an opportunity for the oil marketing companies, which are facing the overhang of the longer term negative impact on the demand for petrol and diesel, as we see more and more electric vehicles come into the market, and the government and the policy kind of discouraging the use of fossil fuels. So we're also seeing CGD companies like IGL stating their intent to get into the mobility market, to get into electric charging. So although in terms of the business model and the potential and the growth, it is still early days, involving the business model. But I think it's an opportunity where the existing companies involved in distribution of fossil fuels will be able to get into the greener fuel options, and in the meanwhile also ensure that the conventional fuel market is serviced, so that we make the transition smoothly. So in terms of the direct budget impact, we don't have any ideas there, but if you're looking at the overall sector calls, we are positive on companies like GAIL, HPCL, and in the CGD sector, IGL. So I'll stop here and it over to the next speaker. Thank you very much.
Abhishek, you can
Yeah.
pick up on specialty chemicals.
Sure. Good evening, everyone. So I'll cover the specialty chemicals part. So Ramesh sir has just touched upon basically this acetic acid and methanol duty cut that we have seen in the budget. So if I look at our specialty chemicals universe, this is the only meaningful announcement that we see, which can basically impact, like he mentioned, basically the cost effectiveness of these companies will improve. So both these chemicals taken together, India imports around more than 10,000 crores right now as on FY22. So this will definitely benefit some of the crop protection as well as CSM companies, and also some of the specialty chemical companies that we cover right now, because methanol and both acetic acid, more than 70-80% of the demand right now is met through imports. So since there are no specific announcements here, I will talk about our view on the specialty chemical space as a whole. So we continue to be positive on the space. although we don't relate this China plus and import substitution story to each and every company, we see few pockets wherein these themes are very much relevant. Especially, the kind of capacity additions that some of the companies are doing over the last 3-4 years. And we expect this rate to go up even further. So overall, if you look at the visibility in terms of earnings, we believe that overall the top 8 companies or in terms of size, the sector can actually grow at 25% earnings CAGR over the next 5 years, which is unlike many of the other sectors in our view. And clearly, this import substitution and China plus are the drivers. And these companies have invested significantly in the R&D as well as the talent pool, and they have built up these relationships with the client over the last decades. And we'll see a disproportionate gains in few companies going ahead. Our discussions also with some of the chemical experts indicate that USA, Europe, and Japanese clients are aggressively looking at India as an alternative supply destination. And that is purely because of the technical capabilities that we have, and they are ready to pay premium also for the same. So we continue to remain positive on the space. But looking at the overall this thing, few companies are incrementally investing majorly in the specialty part of their portfolio. Unlike some of the other companies who are adding capacities in the commodity space, these companies will report improvement in the product mix, and their margin profile will also improve structurally, and that is a very positive point according to us. And apart from the specialty chemicals, I mean the synthetic chemicals part, we also like oleochemical space, and specifically the players who have this application and R&D set up of their own, and also they have the technical marketing strength or the capabilities to develop and basically sell their products worldwide. So we continue to be positive on these two themes. In terms of chemistry, we particularly prefer fluorination. We have done some work which suggests that the salience of fluorine will continue to grow meaningfully, and players like Navin Fluorine, SRF, and GFL will continue to be beneficiaries of this fluorine story actually. But within that, we prefer Navin Fluorine over others because of its presence in the CRAMS segment, which is a very high quality segment, and they have built up these relationships with the investors, and we believe that the optionality angle in Navin Fluorine is significant, and they will deliver on their promise actually. So in the overall space, the top picks from my side are Navin Fluorine and Fine Organics, and I'll stop here. Thank you. And maybe I'll hand it over to consumer sector.
Yeah, thank you. So I cover the consumer sector at Nirmal Bang Institutional Equities. From a budget point of view, the union budget may not have met the general expectations of being a short-term consumer or consumption booster, but as already conveyed by my team that it's more of a long-term growth-oriented move. But specifically to the sector, from a budget point of view, the most relevant category within the sector is tobacco or cigarettes. In the current budgets, there is no mention of any change in tax or addition in cess on cigarettes in the budget document. So we see there's no negative news in the budget on cigarette as a near-term relief for organized players like ITC till the next GST Council meet or the union budget. Secondly, there are certain amendments to the basic customs duty of certain inputs like cashew, wheat, maize, millets, sorbitol, essential oils, and cocoa beans. So relevant companies which kind of imports those raw materials will have some benefit. Thirdly, apart from that, despite the absence of direct measures for the sector, it is expected that other announcements aimed at boosting growth amid the rising inflation will have an indirect benefit on employment and demand generation over the medium term. While there was a higher expectation for allocation towards certain rural schemes, I think measures like higher MSP allocation would really go a long way in helping drive consumption of FMCG products from a hinterland point of view. And this would be really beneficial for companies with a strong and improving rural footprint. For example, Hindustan Unilever, Colgate, Dabur, Marico, Britannia. All these companies have more than 35% kind of rural mix. I think it will be very, very beneficial for these companies over the medium term. So while the unit budget does not help drive the medium-term consumption ball or near-term consumption ball rolling, but it does not really also play a very big role in terms of changing the fundamentals or the valuation of our coverage companies. So we currently have a positive view on Hindustan Unilever, Tata Consumer, Marico, and Britannia in the FMCG space. And within the discretionary space, we are positive on Jubilant Foodworks and Westlife Development. So yeah, so that's all from my side. I'll now hand over to Mayank to take up the capital goods and consumer durable sector. Yeah, thank you.
Yeah, thanks, Vishal. Myself, Mayank, I cover capital goods and consumer durable sector and Nirmal Bang institutional equities. Basically, if you look at consumer durable sector, as we know that government has been very serious about shifting the manufacturing in white goods as well as in the mobile phone, at least the component side, and they have been declaring the PLI schemes for the various categories like lighting, room AC, and motors, and also they've done quite a lot of announcement in last 1 year. Therefore, in this budget, we have not seen much announcement like further extension of PLIs or maybe increment in the import duties for the PCB board and room AC compressor, refrigerator compressor, and all. So what I understand is that it has taken pause for some time. Maybe they will announce further duty increase in the refrigerator, in the room AC compressor, because they have already been guiding that it should increase to 20%. Currently, it is at 15%. And even in PCB and all, the duty is only 2.5% right now. So the duty is slated to increase, but we have not seen that increment here in this budget particularly. But they have highlighted that going forward in FY 23-24, they will take in the duty will be increasing. What they have introduced in this budget is the custom duty on the wearable and the hearable devices. So wearable devices like smartwatch and all, which currently Boat is manufacturing in India, and we know that Dixon is really tied up with Boat and their manufacturing wearable devices. So this is positive for companies like Dixon. But this already been in the news for quite some time that there will be duties coming on the wearable devices, and the company, the government has taken a view on that. Overall, these are the changes related to the duty imposition on the components. But if you look at overall budget, there is no direct measure to boost consumption like tax hopes for the salaried class and all. We believe that the affordable housing scheme and the capex allocation of 7.5 lakh crore will boost consumption in medium term, and this is going to be positive for the sector. So at least for the consumer electrical sector, where the real estate demand will see an uptick due to the affordable housing and all. So this is positive in my view for the sector in medium term, but we have not seen any short-term changes related to the duty. So this is on consumer durables, and on capital goods, as Mangesh has already given a picture on the slides, that individual sector-wise capex allocation and all. So I think that this is a very positive news for the product-related capital goods companies like Triveni Turbine and Solar, Power Mech is an EPC, but other product-related companies would probably see an uptick given that there would be widespread capex recovery. So private capex already a lot of buzz around capex recovery, but government capex will support that there will be widespread capex recovery, which is needed for a lot of large capital goods names for re-rating. So yeah, net quite positive for both the sectors, consumer durable and capital goods. So my top pick in the consumer durable space is Crompton Consumer, Whirlpool, Orient Electric, and in the capital goods it is Triveni Turbine, Solar Industries, and Power Mech projects. Yeah, so that's it from my side.
Okay, can we have Amit?
Yeah, hi. I cover hotel, reality and logistics out here. Good evening, everyone. I think the hotel sector was the biggest disappointment in the budget because there's a lot of expectation from for the hotel sector, given the fact that the COVID impact on the hotel sector was probably amongst the maximum. There are a large number of hotels which have closed down and near closing down. And in this includes some of the larger ones also who have been losing money because occupancy levels have gone down to about 10 or 15% in the peak of COVID times. The only thing which has happened is that ECLGS scheme, which is basically emergency credit line scheme, whereby the hotel can borrow from the government at cheaper interest rates of about 4 to 5% in case of financial distress. I mean, that is the only thing which has happened to them. I mean, that has been carried forward till March 23. So apart from that, there's absolutely nothing in the hotel sector. Having said that, not much I can add on the hotel sector. We do like the hotel sector. We think it's a good recovery play. And, we like all the hotels, I mean, listed out here, Indian Hotels, Chalet, EIH, and Lemon also. Out of which probably the top pick would be Indian Hotels in this thing. So that's all on the hotel sector. Can I go into real estate and okay. Out of the stocks sectors which I cover, I think the biggest thing which has happened is for logistics. There are no tax breaks per se for the logistics companies, but I think as a part of PM Gati Shakti master plan, and also what was said earlier by Teresa and a couple of other analysts, that she's put in about 25,000 crore for 25,000 kilometers of roads to be built in this particular thing in this particular year. Now that I think is extremely positive for the logistics sector, because logistics sector is in the business of transportation. So for companies like Blue Dart, or for that matter Concor also, which is benefiting from this dedicated freight corridor which is coming in, implementation all these schemes and actual operationalization of these schemes will lead to a faster turnaround and faster transportation, which implies a higher ROE, ROC as we go ahead. So I think the logistics sector, because of the focus on this entire infrastructure growth by the PM Gati Shakti master plan, is going to benefit the maximum. And we have Concor and Blue Dart as topics within the sector. Concor primarily because focus on, he's a container corporation of India, which is basically transportation of containers. So he benefits completely from this dedicated freight corridor, which is getting operationalized. And Blue Dart because of better transportation, better roads, which implies a faster pickup and faster turnaround time for Blue Dart also. So we have Concor and Blue Dart as the topics. Can we go into reality? Yeah, again on real estate, surprisingly, there's absolutely nothing at all. Earlier, there used to be, in consonance with Pradhan Mantri Awas Yojana, there used to be a TIBA, whereby companies which are doing affordable housing development, they got tax breaks and tax benefits. If the project had been approved by the government. Unfortunately, I didn't see any carry forward of that particular tax break as we move ahead. So I'm presuming that that particular tax rate expires in March 22. However, the only thing you can say is this Pradhan Mantri Awas Yojana focused on affordable housing scheme, and the increase in expense out here about 48,000 crores expected to be spent on that. And if this is done in private-public partnership, that should help residential focused companies, especially in this. And if I have to pick up residential focused companies, Brigade and Prestige, and Brigade would be a top pick out of these ones. That's all from my side. Thanks.
Okay. Yeah, this is Girish here. So I cover the IT services space. Nothing specifically connected with IT services that came in the budget. All I can think of is there is some proposal to connect 1.5 lakh post offices through a co-banking solution. So that could be a fairly significant project that any of the big players in the IT service industry could potentially bag in the days to come. And I can think specifically of a TCS and Infosys here, and more importantly TCS, because TCS has done an acquisition, or has taken over the Post Bank, which is the from what I understand, this is the postal banking system in Germany, which was actually taken over by Deutsche Bank at one point in time, and they have been working on that, the IT project of Post Bank Germany. So I think there is a fair chance that somewhere down the road, a very large contract will be given out by the government for the implementation of a core banking solution for these 1.5 lakh post offices. And either a TCS or an Infosys, both have been involved in some very significant governmental projects in the country. And some of them, I mean, TCS has done a fairly good job there. There's a fairly patchy track record for Infosys in the governmental projects. So we'll wait out there. But otherwise, I think there's nothing major on the IT services side that the budget had kind of addressed. But we are kind of positively inclined to the space as we speak, because I think what we are seeing here is an acceleration in growth for the industry. So pre-pandemic FY15 to FY20, the tier 1 players, the top 5 players were growing revenues in that 6 to 7, 8% kind of region on a CAGR basis. We think that growth between FY21 to FY24 could be double of that. It could be 14-15%. And earnings growth, again, could be somewhere in that same region, about 14-15%, double of what we've seen pre-pandemic level. So there is a accelerated growth that one is seeing in the industry, and which I think will sustain for some amount of time. What is probably changing at the margin is, I would say, risk perception, risk appetite. So while when I look at the P multiples of the tier 1 and the tier 2 stocks, they are at levels which one has never seen in the last 10, 12 or 15 years. Partly that is contributed by the acceleration in growth, and I think partly that's contributed by the very low interest rate regime globally, which I think is changing at the margin. So very difficult to quantify how much of the significant P multiple expansion is because of the low interest rate regime abroad. So my sense is that could be coming off a bit with talk of accelerated pace of tightening in the US and elsewhere. So that is something to watch out for. But otherwise, we fairly positive from a growth standpoint. I think probably there's like another 2-3 years of good runway for the industry because of this digital transformation story that's kind of playing out with its customers. Basically, all the customers are spending more on technology. Through the course of the pandemic, their business models have changed quite a bit. So whether it's connecting with customers, suppliers, or even employees, they've had to run it in a very different way compared to pre-pandemic, and which has required a lot of investment in technology, I think. So I think that is going to be the key driver in the next 2 to 3 years. Within the space, we like HCL Tech and Tech Mahindra more from a valuation standpoint. We think that the market is being a bit ungenerous in valuing HCL Tech and Tech Mahindra at significant discounts to TCS and Infosys, which I think aren't really warranted. So broadly, that's what I have to say about IT services sector. As I said, the risk is of a P multiple compression. Maybe the earnings growth is going to be reasonably strong. I think the only bigger risk I see is which the one I talked about from a market standpoint, which is that if central banks decide to tighten very aggressively in the face of heightened inflation, which is going to stay there for a long time, I think that could be a worry, which could mean that we could see a pretty significant slowdown in the growth rates in US and elsewhere, maybe towards the end of 2022 or early 23. But that is not our base case as we speak right now. So I'll then pass on to my colleague who tracks the pharmaceutical space, Vishal Manchanda. Vishal.
Thanks, sir. Good evening, everyone. So nothing important that we noticed in the budget for the pharmaceutical sector. So it has typically been the case, the budget is generally neutral to the pharma sector. A few things which will have only a very marginal impact is reduction in duty on common intermediates which are used for making APIs. So methyl alcohol and acetic acid. So these are generally commonly used basic ingredients in most APIs. So it'll have a very minor impact on margins. So not a significant upside here. Right now, if you look at the pharma sector, we have a positive view on the sector. So companies, the large companies in the sector are now cash surplus, and they'll continue to generate good free cash flow as the Indian markets is compounding for most companies in the 10 to 12% range. The US market is where the optionality is. So I think in the next 2 years, probably there is a good chance that we can see a run up in the US sales for most large pharma companies. So basically what we are expecting is monetization of the R&D efforts that companies have been investing in over the last several years. So within the sector, our topics are Sun Pharma, Reddy, and Cipla. So Sun Pharma is the one that has addressed the core challenge that Indian pharma sector is facing, is how to grow in the US. So they have addressed that challenge, and they can now structurally grow from here on. So that would be a topic, followed by Reddy's and Cipla. So on Reddy's, I think US, they have multiple targets to launch in the US in the next 2 years. Not sure if all of these opportunities would be monetized. But I think the most important thing for Reddy's would be to capitalize on the China market opportunity, which is unique to them. So they are the largest in China, and that is where they have been investing for quite a long time. Their product pipeline is getting larger. So if they crack the China market, we probably, it could be Reddy's can continue its growth trajectory for the next 7 to 10 years, and it can be a re-rating candidate. Cipla is the third pick that we would want to highlight. So here, Cipla again is a US-led story in the next 3 years. So they have multiple launches lined up in the US, which can probably add about 40 to 60% on their existing US base, and they are one of the strongest player in the Indian market. So in Cipla, we see very little downside risk on the base earnings, and kind of earnings, if in the best case, earnings can probably double from where they are today. So that's it on the pharma sector.
So with that, we come to the end of the presentation from the institutional research desk. Thank you for your patience, and I hand over the session to the retail team. Mr. Sunil Jain, the research head, will be taking over from here.
So what we had, you definitely got a very good glimpse of what the budget is, and definitely you must have heard many times that for different sectors there is nothing in the budget. So it's a more of a broader principle which has been a key thing in this budget, and you heard from Girish and Teresa, our economist, as well about that. So I'm not going to repeat all those things again. I'll just take a few minutes to give that budget presentation related to budget, and then try to correlate it with the current market situation, both India and globally, how the market is likely to play from here, what we think about the market direction from here. So the expectations from the budget were that India is coming out of pandemic. So and a lot of stimulus was given during the pandemic, and FM is not expected to provide any great stimulus in this budget. So this was the expectations, and then also economy has already bounced back and reached to our pre-pandemic level, and we are definitely running at a very high deficit, fiscal deficit, and increase also having a high inflation also. So the more thinking was that the fiscal deficit will be reduced, and there will be FM will be concentrating on that, and there will be some support for the bottom of the pyramid people in that respect. And there was some expectation that since the capital expenditure is continuing since last 3-4 years, and that is likely to continue in this period as well. So against all these expectations, what we got in this budget is that the fiscal deficit remained at a higher level at around 6.4%, whereas the market was expecting at around 5.7 to 5.8%. But against this fiscal deficit, the expectation was that the divestment target will be somewhere around 1.25 lakh crore. But if you see, actually the divestment target has come to just 65,000 crores. So if you adjust both these things together, like the divestment target and fiscal deficit, then it seems like it's okay. Government has been more prudent in assuming lower divestment and increasing the fiscal deficit. If they could have done the other way also, then definitely fiscal deficit target would have been achieved. So it's more of a like fiscal deficit is in line with what market is expecting. Another key highlight was definitely capital expenditures. You had heard a lot about that, and simple thing is that we are seeing consistently increase in capital expenditures year after year. In last 3 years, we had seen FY21 around 27% increase. Then revised estimate indicate that 41% increase in FY22, and then again 25% increase over revised budget in FY23. So this is something extraordinary which is happening, and which is supporting a lot of infra projects with these capital expenditures, and that is likely to have positive impact on various sectors. So this is what we feel is the key highlight of this budget, and which is likely to have positive impact in the coming year as well. So there was a higher capital expenditure planned in road, railway, and communication. So these sectors will have a positive impact. There are some custom duty adjustments happened just to promote PLI scheme, wherein they had increased the custom duty for some product so that the domestic manufacturing can be done. And also there were some reduction in custom duties to reduce the cost of productions for other products. So that can help lower the cost of manufacturing here, which is already very high. So what we missed in the budget is something like support to revival of the demand, especially for bottom of the pyramid people. That is all missing in this particular budget. But apart from that, sectors which are likely to be having a positive impact because of this budget are infrastructure, capital goods, steel and cement sector. And there were some negative impact on auto and oil and gas sector in this budget. So to correlate it with the overall market and overall direction for the future in the market, we'll just try to compare it with what is happening right now. If you see, the Nifty has given a return of around 27.6% in the last 1 year. And this is the totally outperformer against all the market in the world. If you see the US market, which is the second best performance, is at 22%. And if we compare it with market like South Korea, Hang Seng, Japan, they had all given negative returns. And in that also, the mid cap and the small cap has given still a very high return of around 36 and 62%. the sector which has supported all this outperformance are power sector, which has increased by around 96%, metal by 72, sorry, realty by 32, and capital goods 42, IT by 36%. So these were our sectors which has outperformed the Nifty, and small cap and mid cap has outperformed the rest of the market. So in this backdrop, what we see that what is happening right now is that Fed is now changing its course, and there is a quite possibility that the other central bank also to follow the Fed also. We had seen in last many years that all the central banks are now acting together and following the similar type of course. So Fed has started already tapering, and high inflation and recovery forced Fed to double the tapering, and also started interest rate increase sooner than expected. They are projecting interest rate to increase sooner than what earlier they were expecting. And even they had talked about reducing the balance sheet size of the central banks. So if you just think about around 3 months back, Fed was not concerned about inflation and growth and all, and they were all talking at that time that this is more of a trajectory and then it will come back. But when they saw that the inflation is not going back and it's going to stay here, they changed their course and become very aggressive in giving indication about the tightening and reducing the balance sheet size. So this we will feel like it is likely to happen with the other central bank as well. And if you see India market also, what we see that this is likely to, we may see interest rate start increasing. If you see the G-Sec rate, they are consistently moving up and giving some indication about the increase in the interest rate. And even if we see the inflation consistently remaining higher than what the RBI is expecting, and interest rate, the RBI is repo rate is consistently remaining lower. So it is likely to change course in near term, and what we see that the RBI will start increasing interest rates maybe in the next meeting or maybe thereafter by around and expect around the 50 to 75 bips increase in interest rate in CY22. Another very crucial thing which is happening in the world and likely to have a larger impact on other things is that the commodity prices are really at very high level. I'm talking not about just inflation, it's related to each and every and regular use commodity items, and not only listed but even the soft commodity as well. So if you see the crude oil, we had compared it with as compared to what was it before COVID and what is it right now. So if you see the crude oil was at around $58-60 and which is now at 91, so up by around 56% from pre-pandemic level. Coal is up by around 185% from pre-pandemic level, and PVC is up by around 57%. Steel is up by around 72%. So most of the commodity, just a second, sorry. So most of the commodities like cotton, steel, caustic soda, palm oil, which are used on a regular basis, are up anywhere between 50 to even 400%. So these are all having a lot of impact on the cost of production and also on the margins of the corporates or demand side impact. What we had seen in last 1 month, that was a very crucial part of it, that in last month, we saw some corrections in the equity market of around 8-9% at global level in different market. But even in that period, if you see the last column, the commodity prices has not corrected. On the other hand, they had moved up. Like crude was up by around 17% in last 1 month. Coal is up by around 34% in last 1 month. Aluminum up by 10%. So what is happening, like this is more of an anomaly. When we had seen earlier, then equity correct, then also commodity also correct. But this time it's happening other way around. Though equity had seen some correction, but the commodities are consistently remaining high. So that is a bit concerning, as this will have a lot of impact on different part of the economy and corporates. So if you see what is the impact of all these high commodity prices on the corporates. So if you see the commodity prices has already started impacting margins of different corporates from Q2. If you see that the results of those corporates are getting impacted. So sector like auto, pharma, agro, FMCG, cement, steel, all are seeing cost push pressures in recent past. Even transportation cost has increased substantially, so that is also impacting the margins of the various corporates. So high prices not only started impacting margin, but now started impacting the demand as well. So we had seen demand getting impacted for auto, for FMCG, for consumer durable, and in recent past for cement and steel sector as well. So there is a double whammy. One, the demand is getting impacted. Another, the margin is getting impacted. So Q2 result has got impact on account of higher commodity prices, and that is getting continued even in the Q3 as well. So if we analyze the result impact in the Q3, which is halfway up till now. So the result which were above expectation and below expectation of analysts, then it has moved in favor of below expectations in the ratios of 52 to 48. Generally, what we see that the above expectation results are over 70%, 75% if you see in the Q1 and last Q4 and all. But in recent past, it has turned bit in favor of below expectations. So this will likely to have an impact on the overall expectations of the earning growth and expectation of earning Nifty earnings for current year. One more aspect is that earning growth is projected by analysts at a very high level. So there is a EPS for Nifty growth is expected at around 38% for FY22 and then around 19% for FY23. But these are all on the lower base. If you see the last 3 years, the base was quite low. And because of the lower base, the earning growth has turned comparatively positive in this period. And we are seeing high growth. If we take a longer term EPS CAGR of say around 2025 year, it is 12%. And even in if last 5 years, if we see the earning CAGR, that will also come to around 12 to 12.5%. So though optically we are seeing very high earning growth or high earning growth in high EPS growth in Nifty for FY22, but that is more of a lower base impact. And one crucial part of earning growth is that it is more of a driven by a few sectors or few commodity price commodity led sectors which are driving this high growth. So there is always a risk of returning of this high growth turning negative coming off. Another aspect which need to be watched is why the market, the Indian market has outperformed most of the emerging market or even developed market in last 1 year is the domestic money inflow. I think this is one of the crucial point which is keeping our market ahead of other market is that the domestic flow is very strong in Indian market, and it is something which is happening structurally, which is keeping the market strong in near term. And we are seeing even consistent outflow from the FII is not putting any great pressure on the Indian equity market. That is mainly because of the investment by the Indian domestic individuals. So if you see the domestic direct inflow from the account individuals is very strong. There are almost around 35 lakhs new account are getting added in the recent past every month. So that is bringing in new money to the market, and that is keeping the market at a structurally very high level. If you compare it with other emerging market, India has really done very well on equity performance, and we feel that this is one of the big reason which is helping the Indian equity market to perform well. And not only in this way, even the cash inflow in equity scheme of the mutual fund has also improved, and that is also supporting the Indian equity market. So this factor will keep on bringing in, will keep on supporting the Indian equity market, even if we see global corrections. And valuation, if you see, is at higher level and are higher than the previous peak and consistently remaining at higher level. And one of the reasons for that higher valuations is the domestic money, which is been supporting the market. So, sir, Nifty EPS, Nifty is trading at somewhere around 20 times FY23 earning, which is much higher than the average of around 16 times for last 7 years. So in all conclusion, if we see that FM has presented a growth oriented budget and can support some sectors related to the infra related or infra supportive sectors like cement and steel in near term. Fiscal deficit is inflationary scenario is concerning, and because of the high inflations, Fed has changed its stand, and similar thing is likely to happen that Indian equity RBI will again start increasing interest rates in the coming period. Biggest concern is the high commodity prices, which is impacting corporate results, and if you see earnings are improving, but not across the board. It's now getting in specific sectors. Earlier, if we see, we were seeing earning growth across the board, but in last 2 quarters, that is the second quarter and third quarter, the earning is now getting concentrated in few sectors, and we are not seeing growth across the board. And valuations are definitely at a higher level, which is been supported by domestic money. So we feel that market is likely to remain range bound and not likely to give a clear-cut long run from here. Any pressure from the international or domestic market will be supported by the domestic liquidity, and it will be more of a stock-specific market in the coming period rather than single way really. So one need to be very specific about the stock, and that's why we are recommending few stocks, and some of the top picks are there. I'll request my analyst Jehan to talk about stocks from here.
Good evening, everyone. So our first topic is Home First Finance. It is an affordable housing finance company having a significant presence in Gujarat and Maharashtra. It started in Gujarat and currently has around 5% market share over there. The strategy is to grow on the outskirts of urban cities. So, for example, their next target is to increase their market share in Chennai from 1% currently to 5% over next 3-4 years. If we talk about competitive positioning, what is differentiating about this company are four key reasons. First one is the average ticket size of 10 lakhs versus, let's say, other listed NBFCs like Canfin having around 23 lakhs. And if we talk about HDF, second point on the loan to value front, Home First offers slightly higher loan to value than Canfin, which in turn offers slightly higher than HDFC. So that's market segmentation where each company has developed their own USP. Client-wise, 25% customers are self-employed and 75% salaried. This is the opposite of what the mix for Aavas is. And within 75% of salaried, 50% is organized and 25% is unorganized salary. So if we look at the unorganized salaries, then add the self-employed 25% and total around 50% of the book is the portion where they have very low competition. This is a significant area for edge because if a random customer walks into any bank or even companies like Canfin or PNB Housing Finance, the first thing that they will ask the borrower is to submit 6 months of salary slips and Form 16. So this is an edge. Also, 28% of their clients are new to credit. So where the income assessment becomes that much tougher and a deeper understanding is required. And lastly, Home First also takes into account the family income rather than just the individual income. So combined these factors, this is the reason that companies like Home First can command a yield of 13%. Another favorable factor is that companies sticking to core home loans as the segment and not diversifying much into developer loans and LAP, where companies like PNB, LIC, and Repco have faltered over last 4 or 5 years and accumulated big NPAs. So even post-COVID, if we look, Home First's performance on asset quality front has been in line with what Aavas has demonstrated, and it is much better than the other third listed affordable housing company Aptus. Over last 5 years, if we see, they have grown their loan book at almost 50% CAGR, but obviously the loan book, the base was very low. But if we see today, even in Q3, the loan growth was at 27%, which is one of the highest in the listed financial space. And we expect that over next 3-4 years, they will be able to grow their loan book at 30% plus, given the small base of just 5,000 crore loan book. In comparison, Aavas's loan book is at around 10,500 crores. So there is a good scope over next 3-4 years for them to grow at a fast rate. And lastly, if we talk on valuations, this company today is trading at 40% discount to Aavas, which we feel is unwarranted given the higher loan growth in future years and similar kind of asset quality. So we feel that in the near-term perspective itself, the valuation gap should shrink from 40% to 20%. And we have valued HF Home First at 37 times FY24 with a target price of 1100. That's it from myself.
And I'll request Kansha to talk about this topic on Infosys.
Yeah, good evening, everyone. Our second topic is Infosys, and with the new CEO joining in and the company's new strategy to accelerate growth, this has started to show in the results. With this, over FY19 to 21, deal pipeline grew at a CAGR of 49.8%, which is the growth is higher when in comparison to TCS. 9-month FY22 TCV stood at $7252 million. The company's employee base for the quarter stands at the highest, indicating that the demand environment is strong. With this in Q3 FY22, the company has posted strong quarter in spite of being a seasonally weak one, wherein revenue growth Q on Q in CC terms came at 7%, which is one of the highest growth. The strong performance was majorly due to sustained strategic focus on areas of clients in digital and cloud, reskilling of people, and deep relationship with the clients. With this, for the third time, management has upgraded the revenue guidance for FY22 to 19.5% to 20%, and EBIT margin is expected to be in the range of 22 to 24%. Even with higher deal wins and demand environment being strong, we feel Infosys is likely to post good growth going ahead. And we feel the stock is available at an attractive valuation of 28.2 times FY23 EPS. Thank you.
Good evening, everyone. So I would be presenting on Sapphire Foods. Sapphire Foods is the franchisee which has Pizza Hut and KFC as their franchisee, similar to Devyani. However, Devyani has more number of stores than Sapphire. We like Sapphire Foods mainly because of the two reasons. One is that the industry growth. The industry, food services industry is growing such a healthy pace that the players in this are likely to grow further. And within that industry, the QSR chain, organized QSR chain is growing much higher and likely to dominate the overall industry from currently under 50% by FY25. So that is why we like the players in Sapphire, players in this industry. Second is to cover this or to take the advantage of this industry growth, Sapphire Food is also increasing their store expansion. And they have given that they would be doing adding on 500 stores by next 2-3 years. So this is an additional thing which we like. Also, what they have done within their store format is they have reduced the size of the stores, which is actually benefiting them because the cost has come down. However, they have seen that the revenue per store has not come down. That is why we are seeing that the quarter on quarter there is an improvement in the margins. So that is why we believe that industry plus the store expansion would drive the overall growth for Sapphire Foods. It is trading very attractive valuations as compared to all the listed players like Barbecue Nation, Burger King, Devyani, Jubilant Foods. So this is another attractive point which we like about Sapphire Foods. The next stock we are covering today is Shoppers Stop. So this is a retail chain. This is one of the oldest retail chain in India and has a very dominant position and a very good and strong brand equity among its shoppers. What has really changed in the company is that Mr. Velu Gopal Nair has joined Shoppers Stop from November 20 as MD and CEO. He has 27 years of rich and varied experience. And before Shoppers Stop, he was earlier CEO of Westside at Trent. And we have seen the kind of growth that Trent has witnessed in the past few years. And he has been instrumental both in organic and inorganic expansion of Trent. So we believe that being such a strong, experienced leader coming on the driver's seat, we like that Shoppers Stop would also do well. We have already started seeing the early signs of the recovery and the turnaround in the company. The company has started investing on their digital space and now very encouragingly and very proudly dominates and showcases both their omni-channel, wherein they're present both in offline as well as online channels. The digital revenue is now contributing 39% of FY21 revenues. They've also identified 4 strategic pillars to go further. So first is the First Citizen, that is their loyalty program, which is now contributing to 70 to 75% of revenues. And they're very positive on this First Citizen and focusing on this. They also started the personal shopper service, which is first in kind. So wherein any shopper or any person who wants to have a personalized shopping experience can get in touch with the company through WhatsApp and other means. And the company could take care of the overall turnaround of the person. This third pillar is the private brands, wherein they have their own exclusive brands obviously the margins are also higher here, and that is also driving the growth. Currently, it is contributing around 14% of the revenues. They have also increasing their share of the reach within this with this private brand. So earlier it used to be only women wear. Within women wear, they have gone to uh, different regions, and now they are going to infant and baby wear. The fourth pillar which they have identified, and we have always seen in the other listed companies that we are very positive about, is Nika. So here also they have identified beauty as the one of the key strategic pillar for the future growth. The management is very bullish on this segment. They have also launched around 70 new brands in this fragrance and skincare category. And they're also launching standalone beauty stores which named with Too Faced. So those are not any apparels attached to that. And they are really bullish on this segment. And we are too also believe that this is something a company should be in. The segment should company be in. Coming to valuation, under Venugopa's leadership, we believe that Shoppers Stop is moving in the right direction, especially with its omni-channel strategy, as we explained earlier. It is trading at a very attractive valuations as EV by beta. If we compare it with Trent or AB FRL, so it is trading around 6.8 EV by beta times on FY23 as compared to 43 and 20 times respectively for those companies. So any turnaround in this would be really would drive the company really well, and we believe that it is very high potential. However, in the near term, the company has said that there can be some slowdown in Q4 due to the Omicron wave. And but however, just to take a little medium to long term point of view, we are very bullish on this. The last talk for our topic is Supriya Life Science. So this is a API company which got recently listed. This is a very niche focused and niche company. They have only 38 APIs in their portfolio, and among that also top 5-10 products contribute around 50% of their revenues. In few of the products, they're not only leaders, but they are actually dominate the export region from India. So just to give an example, that ketamine hyalochloride, in that they contribute around 60 to 65% of the API exports from India. So they have that kind of leadership position in the selected molecules. Coming to the reasons why we like this company is they are backward integrated. Being an API and bulk and volume centric industry, having the backward integration is a major benefit, which the company has also understood and going in that. So 12 of the existing products are there backward integrated, which contributes around 67% of the total revenue. This, what it does, how does it help is that it results in better margins and lesser dependence on suppliers. We have recently seen that many companies have faced supply side issues due to probably non-availability of containers or higher freight prices. Therefore, somehow their supply and their production has also impacted. However, if you are backward integrated, you won't face such problems, and also have a better control on the cost. And that is what we are seeing in Supriya Life Sciences. They are able to increase on their margins, as you can see from the table below. And if you see from the past also, they were around 27% margins they had in FY19, which has moved to around 43 in FY21. That is because they are backward integrated. And also on the front end side, they're getting higher share or higher revenues from the regulated markets. We all know that the regulated markets give better realizations, and that is why the companies enjoy higher margins. So slowly and steadily, their margin, their contribution from the regulated market is increasing. Just to give an example, that regulated markets contribute 38% of overall revenues in FY21, which has already moved to 47% in 9 months FY22. And we believe that this is likely to continue in future also. Now we have seen that they have quality manufacturing, they have the capabilities. So the company is to monetize all these qualities. The company is getting into CRAMS. CRAMS is in a very attractive space where if you have the right kind of products and the quality manufacturing base, global players would like to come and work with you and give you much higher margins. They are not concerned about the margins. They are only concerned about the supply chain consistency and the quality consistency, which Superior Life Science has already showed and shown in the past, and they have a proven track record of that. So with CRAMS, they're focusing on CRAMS. We believe this could be a major growth driver in next 2 to 3 years. They currently have 4 active projects under consideration. However, they would take another 1 year to start revenues from them. Q3, if you see that after Q3, the stock has gone down because the Q3 numbers were not as good as the street expectations. However, the reason given by the management is because seasonally they have strong Q2 and Q4. And over and above that, Q3 saw some deferment of the orders due to the month and year, December ending disruptions we have seen. So because of this, Q3 was little subdued. However, this is likely to normalize in coming quarter, and management sounded very confident of maintaining their 40% EBITDA margins with 18 to 20% revenue growth. So because of this, we like this company. This is, however, not very cheap, but this is not expensive also. If you compare it with Divi's, which is the leader in this space, Superior Life Science is actually trading almost half to the Divi's. So we believe that this has much scope to grow from here, and we like this company. Thank you.
So I'll request Kunal to talk about, take the presentation forward from here.
If you will talk about the personal finance perspective or the common man perspective, that we have seen that there is no changes in income tax slab in rates, but yes, in terms of filing the income tax, there the finance minister has given a leeway to go. You can rectify your mistakes if you have done it in the last 2 years. So that is one of the key pointers has come up in this budget. And secondly, on the NPS front, if we'll talk about, then there was a lot many expectation from in this particular space, because this is like one of the instrument which is getting a tax benefit from the investors point of view, apart from section 80C, which we get it on a regular basis. So here not much, but yes, the difference between central and state governments, there was a different limits was there to invest in this particular product. So that has been reduced from 10% to 14% from the state government employees, which was earlier different from the central government and from the and on the central government. So that is the second point. And third point, if we'll talk about the crypto investment, so as we have seen that the taxation on the cryptocurrency and the digital currency has been cleared. Earlier, there was no clarity on this particular product, whether it's a legal in India or not. So government has announced, and the finance minister actually has announced a 30% tax on any income from the investment in these particular asset class, and no other exemption and deduction they have allowed. Okay. So no other deduction they have allowed in this. The third is introduction of central bank digital rupee currency. Just hold on a sec. My screen is Abhishek, my screen is visible or not?
Yes, ma'am, it is, ma'am.
Okay, one sec. I'm just, I think somebody has messaged it's not visible. So I hope now it's visible.
Yes, ma'am.
To everyone. Okay. So cryptocurrency, I was talking about, so this was earlier, there was no clarity on this particular product. So in this budget, at least, finance minister gave the clarity that what would be the taxation applicable on that. And with that, 1% TDS would also be applicable in this particular product. The next a very good point, or the point has come up in this budget, is integrating post office with core banking. So if we talk about the post office, it's a very large network, and that they are trying to connect with the core banking. So core banking means the person or the investors जो भी depositors हैं, they are going to access their post office investments through net banking, mobile banking, through ATMs. So there are the various online transfer or online platforms would be there to transfer this kind of transaction. So that would be a big positive in terms of connecting and doing the transactions. So probably if you are investing, as of now, if you are investing in one post office, you have to go in that particular post office only to invest or to do any kind of additional transaction in your deposits. So here this kind of a facility you are getting. And the next is a surcharge. So surcharge, if we'll see that on the long term and long term capital gain from listed and unlisted companies will be capped 15%. So earlier there was a lot many slabs were there, you can see on the screen. So after 2 crores a slab, they have scrapped and they have just made it flat 15%. So this particular capital gain thing is in an unlisted space, definitely is going to be a big positive from the HNI and ultra HNI investors point of view, as generally they look forward for a investment in unlisted space. And as of now, if we'll talk about unlisted market, it is going to it is pretty big, and HNIs in HNI segments, this is quite popular. So if we see this surcharge deduction in surcharge, definitely is going to help to boost this particular segment. On the normal budget side, as our institutional and the retail team already has spoken about the budgets, as we know that the budget is primarily focused on boosting the economy recovery. The finance minister has proposed to step up capital expenditure like the previous union budget. This year too, infrastructure formed an important part of the proposed capex outlay. Because the sector is an important drivers of economic growth and employment. So apart from infrastructure, the government also boosted various segments like healthcare, education, digital ecosystem, agriculture, among other various sectors. So if overall, if we'll talk about from the capex perspective, definitely this is going or bodes well for Indian equities over medium term. But on the other hand, if we'll speak about the fixed income market, it has shown some disappointment, as we have seen that the fixed income market today, that was we have seen a jump in yields by 15 to 17 bips. First is on a revised fiscal deficit target for FY 2022 to 6.9%, in spite of higher than budgeted revenue collection, and at the same time higher than market expectation in front of budgeted deficit target of 6.4% for FY 23. So India is likely to borrow 14.95 lakh crores via bonds in FY 23, according to budget documents. So in the backdrop of higher oil prices, hawkish US Fed, and the pressure on the RBI to tighten monetary policy, the higher borrowing will see bond yields rising. Across the yield curve, over the course of action, we expect bond yields may harden from here on. RBI has so far maintained an accommodative policy stance and expect to be in line with global trajectory in FY23. Though we might not see a direct rate cut from here on, first we might see the stance change from the RBI side and probably then the hike in terms of interest rate. So that is on the interest rate and the bond that is going to impact on the fixed income space. In this budget, Finance Minister also proposed a green sovereign bond, which will be issued by government, and the fund will be utilized for projects that reduce the economy's carbon intensity. It will help India to meet its commitment to achieve the zero carbon emission target by 2070. These bonds will be a part of government borrowing program only from the upcoming financial year. In terms of investment point of view, if we'll talk about in a fixed income space, so we have seen that fixed income as an instrument or as an asset class become a very important for the investors' portfolio point of view, and that is what we have seen in FY20 when we have seen a sudden fall in equities due to this COVID or due to this pandemic. That is where this particular fixed income space as an asset class comes into the picture. So stay away just because of we are seeing some negative or from this particular space is not the right way. There are multiple products in a fixed income space where the investors can invest, or mostly if we'll talk about in terms of investments, then definitely short-term liquid to short-term is one of the space where investors can stick into, and otherwise they can go for a step down maturity. The lesser maturity will be lesser impacted by the interest rate change in whenever it goes upward direction. So that is what investors can do. On the equity fronts, as we have seen many impacts on the few sectors. So one is the infrastructure is one of the sector we have seen, and after a budget generally we see that the thematic investing actually catch up and the advisors generally go for the the thematic investing or advise on the thematic investing. So I would request investors to look for their portfolio, stick to their investment strategy. If that is any sectorial thing is fitting into your investment, so probably you should pick up. Otherwise, would request everybody to stick to their core asset allocation and invest in the diversified, because infrastructure is any which ways is a very diversified sector. So it's not like IT or pharma. So any which ways the multi-cap or the diversified strategies in mutual funds takes benefit of these particular sectors. So that's all from my side, and thank you.
As far as budget is concerned, there was nothing so expectation was that the government will cut the import duty of gold by 2 to 3%, but nothing of, there's nothing in the budget for commodity as a segment. But as far as the outlook is concerned, I will share my outlook over here that whatever is happening in the global economic environment, I think commodities in next 1 or 2 months, I think they are going to peak out. The fact is that the global liquidity scenario is going to tighten going forward, and I don't see any reason why commodity should rally from here from the macro perspective. So the US balance sheet, which is already is at $9 trillion, I think from here the path is definitely on the downside. We are going to see the US balance sheet will decline, and it will go down quite sharply. And I'm expecting, the US 3 to 4 rate hikes going forward. So these are not commodity friendly. Second thing, the supply chain, what we have right now in the markets is going to come back. And the COVID, I don't know about whether another round of COVID wave is going to come in the world or new variant. I don't know about it. But as of now, it seems that things are getting normal. And since things are getting normal, I'm expecting, the COVID, because the COVID cases are going to drop down, the supply side is going to get stronger for many of the commodities. So as far as oil is concerned, I'm bearish on oil. I'm not expecting oil to go above $100. In fact, it can. You cannot say that it will not. It can, but it will not last. My target for oil for next 6 months is $70 first before it hits $102 or $105. I'm expecting WTI to go down quite sharply. US oil production is going to move up from 11.5 million barrels to 12.3 to 12.4 million barrels. OPEC production in next 6 months is going to move up by 2.4 million barrels. So by June, July, oil market will be in the surplus of almost 1 million barrels per day. So that is bearish view on oil. Gold and silver look very attractive from the long-term point of view. Even though the interest rate in US are going to move up, I'm not bearish on gold and silver because we don't know what these what this spike in interest rate is going to do to the global economy and especially to the US economy. So gold 1750 should be the bottom for the year, and it can again test $1,950 to $2,000 going forward. So pretty bullish on gold, and also silver from the demand side looks pretty attractive. Most of the base metals, they can remain strong for next 1 or 2 months because China is initiating monetary easing right now. But going forward in line with the macro theme, that is liquidity tightening, I think most of the metals are going to go down in the second half of the year. And that is going to be the stimulus. So the lower metal prices, lower energy prices are going to be the stimulus for the global economy. That's it. That's it I have from my side.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.